Hey there, everybody. Welcome back to another 21st Century Renaissance and another open interest newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano. Still on the road here. Wonderful to see you all. Nonetheless, coming at us, of course, is another day after some surprising bearishness. Not a whole lot of it, but right, definitely not something perhaps anticipated, given how good our market conditions were looking, how good our broader context was on the whole. Maybe to a certain extent, this this limited to the extent to which we saw some downside yesterday. We did end up having a bit of support there, kind of a question mark at 25 that then went away after hours. So we'll be thinking a little bit about what went on yesterday, maybe what's going on, drawing some historical parallels to some moments last year, but by and large trying to make sense out of potentially what these shorting institutions, right? That's basically what it looks like to me is going on right now with our price action. It doesn't really make sense outside of this synthetic liquidity thesis and volatility cycles. So try to make some sense out of that, try to understand where we are right now, think about our broader context, try to understand, get some insight from the options market. And try to understand too, right? Notice here, the title of today's video, over 99% of calls right now on GameStop expiring this Friday. So that's over 99% of something like 125,000 open calls right now are due to expire out of the money. So we'll be thinking about that a bit as well. As always, thank you very much. Let's blow this up a little bit. There we go. Right. Thank you for our sponsors for today's coffee. Skuxy18. Today I had iced Amazon Extra coffee. It was very good. Had some Thai condensed milk in it and 3 shots of espresso. It was really great. Thank you very much for my coffee for today and for sponsoring today's video. And of course, thank you to Dat Scruffdo. Scruffy, thank you so much as always for your support. And thank you to everyone who has supported in the past and will be supporting in the days to come. You help keep this open interest newsletter, my video breakdowns, everything that I do. You help me keep everything absolutely non-monetized and free and public access to everybody. So thank you so much. Thank you. So let's hop into this today, right? Obviously looking really good yesterday with respect to SPY. We did flirt a little bit early with that, with our volatility trigger gamma flip line, kind of this break between predominantly call gamma dominant positions above 600, predominantly put gamma dominant positions below 600 and at 600. So we played with that a little bit, right? We had, we started to trade up into this area after being a bit down. We kind of retested pre-market lows pretty quickly, gave a little bit of a scare on that little bump, but then, right, we pulled up right in that kind of neutral zone, that less volatile zone below 599 that we pointed out yesterday. Came back over the gamma flip line here in green. Little indecisive above it, right? Couldn't decide if we were going to really commit to being over 601, right? That's where our gamma positive territory really begins. Traded on top of this line a little bit and off of the VWAP +2 standard deviation resistance line. And then for basically the remainder of the second half of the day, hard commitment to moving into that call gamma positive territory. And then we just went into those, right? When you hear me, right, here's a good example. When I talk about slow grind up conditions in the market with a call wall target, this is what the slow grind up conditions look like, right? You can look at it, it just looks like a diagonal line and you're drawing it up to the right, right? It's not volatile, it's not going all over the place like an Etch-a-Sketch or a heart monitor or something like that, right? It's just slowly kind of bleeding up and to the right. So that's what we got, right? We topped out here in the pre-market, early pre-market at about 606, deeper into that territory. What are we looking at right now? Pretty close, right? We're pretty close to there. We were in the 604s for a little bit, 605. So we're pretty close to that territory there. Yeah, and definitely looking good in terms of our gamma. Still strong, where we have a little bit of weakness around 603, but basically if we're above, yeah, 604, we just kind of continue to grind up. We have some neutrality here around 607.50, right? Sometimes in SPY we get these weird 50-cent strikes that kind of pop in. Don't know what's going on there, but right, those, not too many calls get bought there. But then, right, continued conditions, stable conditions, all the way up into a little hang up, maybe at 608, but big, slow grindy move up towards 610. As long as we're in this area, as long as we don't get some news that pushes us all the way kind of back through 602, start to get a little bit neutral at 601. If we do hit 600, we'll see some volatility ramp up to the downside pretty quickly. But then, yeah, we kind of go back to that 598, slightly sub 599 territory, and we're pretty neutral. And then volatility doesn't pick up until we get a much bigger move down to the 595 area, which is a bit of a volatility trigger. And then, of course, as this happens, then traders can make decisions about whether they want to enter in new call positions, whether they want to reverse things, how that's going to look. So things definitely looking good as far as continued consolidation, stability today. If there are no curveballs in the market, or if, I guess, the powers that be don't decide that a news story from a month ago is, can be recycled and is somehow worth, regurgitating today and then using as an excuse for why things dumped, like DeepSeek or something like that. Again, not to be too not to be too speculative here, but if you haven't been able to tell by now, I am deeply cynical with respect to anything that comes out of the mainstream media, be that CNBC, Bloomberg, Benzinga, whatever these institutions are, right? So many times. Basically, right, my default orientation towards them is, okay, whatever they're saying, they're trying to get me to think X or Y based on this. What's really going on here? So as long as we don't get something like that today, then I think those consolidatory conditions, that kind of slow grind up continues. And while we're there, I mean, that's going to give us about as favorable a context for GameStop as we can expect or we can hope for. Right, it doesn't mean that we're completely insulated from any kind of downside sensitivity. I mean, right, even yesterday, we say, okay, yesterday was a red day. Yesterday we traded down. Nobody necessarily likes to see that. You'd expect a little bit better from a pretty bullish day in the broader market. But we only moved down. I think the total down move on the day was maybe like 70 or 80 cents. So not wild. I think we did get up a little bit toward 26 on the intraday high, but let's go take a look at that, right? Let's look at this price recap. What really happened yesterday? And as we can see, it's really a tale. We see this sometimes, right? A tale of two trading days. With the first half of the trading day, really right up until exactly 1 p.m., we had textbook, consolidatory, what was expected, kept pretty close to what the market at large was doing. We kind of had that instability correlated to our price action in GameStop, right? So unsure if we were going to commit to being in that 600 range or above that 600 range, that call gamma dominant range over in SPY. So we traded down a little bit with that test of that 598, 599 area, right? We see this play out, commit to being over this line, and then, right, not necessarily, right, GameStop doesn't necessarily trade up with SPY. It tends to trade down with it, and then when SPY returns to stable or bullish levels, then GameStop kind of trades sideways or consolidates. That's especially true when we're at this portion of these volatility cycles. That is where there is a lot of short liquidity, right? So at this phase of the volatility cycle is defined by a surfeit of short liquidity, where institutions can easily get a hold of shares to tactically short the stock, to control the price, to do this potentially either to concentrate shares, to move it through key or tactical levels, critical levels defined by the options market or our broader technicals, or to use this kind of throughout the day to cause a kind of general or slow bleeding effect, something like that, to kickstart a kind of bearish movement on an otherwise low volatility day. So we had or I should say low volume day. We had extremely low volume basically through this consolidatory period. Nothing really happening. We stuck pretty much, right? We established a VWAP range with our early move here, right? Traded down, touched the pre-market established basically VWAP support level. So that's 2 standard deviations below the volume weighted average price. Traded then up. Day traders, I'm sure, were pretty happy with this. Whoever was able to take this trade went right up from 2 standard deviations below the volume weighted average price to 2 standard deviations above the volume weighted average price. Then day traders exited this position, and then we just kind of grinded sideways on VWAP and this kind of bundle of moving averages. Nothing really happened, kind of a slight bearish bent in it. Then exactly at 1 p.m., we got some heavier volume. We got a much sharper dip. We exited our VWAP channel on no news, on no downturn in the broader market, and then assumed this diagonal continuative move into the after hours period, right, just on a straight line down, or I should say a diagonal line down, to something like 24, I think it was in the 2470s before we got in the overnight market period, a very slight recovery up into the 2480s, right? So that's, I mean, disheartening in the sense that it can be disheartening or frustrating perhaps to some in the sense that that's not a value we've seen on GameStop. That's not a price level we've seen in a long time. And certainly if you're using our regular indicators to try to predict the likelihood of something like this happening, seems to be very low likelihood, seems to be very low probability. If this, where is the consolidation? Where is, well, as we'll see in a second, right? Where's the actual volume to bring this about? Like, why has trading volume kind of dried up here? Why aren't traders necessarily trading off of technical levels? Why is the stock avoiding, it'll conform to technical patterns, key resistance or support levels, and then all of a sudden seems to just abandon these kind of out of nowhere, despite the fact that we don't have a lot of volume or attention. So, what's really going on there? What brings this about? And I pointed this out before. What this really looks like is this is purposeful and controlled tactical shorting. Now, I know, right? If you go on Superstonk, if you go on Reddit, if you go on whatever GME page, if you go on X, and you see, right? I think maybe you get this, maybe some less of this on Superstonk nowadays, but there was a time where you saw quite a lot of this, where like any kind of red day was just like, shorts, it's people shorting, they're doing all this, right? And, if you throw a dart at a dartboard, you probably have a non-random chance about being right about that, right? Based on the history of GameStop in this particular, in this particular, I don't know what you'd call this 4 or 5 year saga at this point. But really, we'll see these kind of it'll be conspicuous, right? We'll see these kind of turning points abruptly, when basically everything around this says this isn't what should happen, right? We should hang out around these historical resistance points. There's been this effort to build this bearish regression channel. Why aren't traders coming in and doing anything with these regression levels when they were so heavily, and had been for so many months, so heavily respected? What, all of a sudden nobody likes to use this chart anymore? Like what's really going on there? What's going on with available liquidity, right? So yesterday, I think I pointed out before, pre-market, whenever I see the available number of shares go down in a few hours prior to open, that more often than not signals to me that someone has the intention of using those shares later in the day in order to short the stock tactically, to intervene in price action and control the stock down with a high, a high number of concentrated short volume. What we did see we had seen the total number of shares get back up to about 2 million pre-market yesterday, and then they shot down to 1.6 and then 1.7 million prior to open. What we saw throughout the day is that number went down to 1.5, and then by midnight, that number went down to 1.3. So it's possible that up to 700,000 shares were borrowed in order to bring about this type of price action, especially what we saw later in the day. It's possible that not that many were even necessarily needed. Kind of what you can do, right? Especially when volume is low, when people just aren't trading the stock, and when we're seeing something like our average volume on stable trading days is something like 3 million shares or 3.3 million shares. It doesn't necessarily take a lot of short volume in order to really kind of mess with the way the price moves. Insofar as you can kick things off with a few 100,000 shares of short volume. You can kind of sprinkle them in if you want, but then, especially as we're getting closer to the end of a week, if you have a big options expiry, once you kind of get that going, right, you can kick some. You can kick call positions, right? You can kick options positions out of the money, and then basically flatline IV and cause all of these out of the money calls, right? Very frequently, especially over the last few weeks, GameStop has just had a ton of out of the money calls based on where we were trading, right? Just a few short weeks ago. We have a huge number of calls up at 30. We have a huge number of calls at 28, now at 27 that are being sold, that are being bought. And especially with bot calls, trader bot calls, dealers are hedging those positions by purchasing shares, since those add negative delta and negative gamma to their books. They hedge that. They always strive to remain delta gamma neutral by purchasing shares to offset that. So as those contracts move further and further out of the money, and we get closer and closer to expiry, they can shed those shares in order to, right, because they have fewer delta, they have a lesser amount of delta, fewer deltas, a lesser amount of gamma on their books. They don't need to hold as many shares to hedge those positions. Perhaps they themselves even know that what they're going to do in order to control the price later in the week. They can shed those shares, and so it's possible that not as many as 700,000 shares were used to short the stock. This type of movement in the available shares to borrow makes me think something like that is potentially likely. But you can get the charm effect, which is delta decay over time, can set in, especially once you are approaching the end, fast approaching the end of a particular week, an options expiry, and you have a high number, especially of trader long calls out of the money. That's going to put this kind of slight minute by minute depressive effect on the price as dealers go ahead and just kind of release shares into the open market by de-hedging their positions. So I also spent some time on my post today. By the way, if you're new to the channel, right, you can find today's post linked down in the description of this video. It's over on my X page, pinned at the top of the page. I go into this, in some greater detail over there, but you can see all these images, everything we're looking at now. You can check out there for yourself, reference it throughout the day if it's helpful. When we look at the technicals, right? If you look at a glance here, and maybe this is something that's even displayed for potential new buyers, right? Is if you come and you look at this, you look at the way that our price action is appearing on our charts here, it looks like a pretty standard bearish regression channel when you look at the way that the stock price has behaved. And so you might say, if you're a new buyer, like, okay, right, we just went into we came out of an accumulation phase. We had this 2-month bull run where markup was occurring, distribution occurred at the top there, and then volume, right, started to taper off at the top. And then, okay, so now we're fully in this markdown phase, and we're just waiting to find bottom, waiting to find support. People are selling, algorithms are stop loss hunting, things like this. But what's very unusual about this, right? According to this, many of you are perhaps familiar with Wyckoff phase theory. Typically, what you see on phases of right, you'll see consolidation. Consolidation takes place in one of two forms at the sort of macro scale like this. One of them is accumulation, and one of them is distribution. So an accumulation phase precedes a market, right? A run-up, a bull trend. This is where smart money or large institutions enter into share positions, enter build positions while the price is low and consolidating and supported, and then wait for, in the anticipation of catalysts, something like that, in order to perhaps see demand from retail or people who are late to discover value in the stock do so, a month or some months down the road. Then you go through a markup phase. And throughout the markup phase, volume will increase as the price moves up and decrease as the price moves down. Okay, so this demonstrates that there is a higher demand for shares than there is a supply. There is a supply of sellers of those shares at lower prices. And so while you continue to see this, and you'll go through periods of sort of mini consolidation, retracement, correction, and so what you'll see on these moments, right, to institutions will look to see if the bull trend is intact, if this market phase is intact based on the level of volume that's being seen. So if volume remains consistently high as the price moves up and lower as the price moves down, this is generally a signal that you can keep pushing your positions higher. You can keep letting this run higher. There are enough buyers. There is enough demand out there to allow the stock to run up. So keep increasing your ask price. Keep letting this run because there's clearly demand to have this thing keep moving up. Now, generally, when you're looking for a turning point, something like perhaps what we saw approaching January OPEX, is you're looking for buy volume to taper off a little bit, which is signaling that momentum is kind of exhausted. You're running out of buyers who are willing to transact at these upper levels. And what you see is you'll see the buy and sell volume kind of equal out. And then the turning point will set in largely when sell volume begins to surpass, right, the volume on selling, on down days, on down candles, on down movements, increases substantially relative to what we see on buying, right? So as the price moves up, volume goes down, and as the price goes down, volume goes up. This is the signal that you're moving out of a distribution phase. So you move out of this kind of range-bound consolidation period, which, yes, we kind of began, we did see volume in this section, right, when we were testing $35. We did see volume comparatively reduce, say, versus what we saw at these lower price levels back here around earnings. It wasn't a crazy drop-off in volume. It was notable. We did, depending on how you look at this can look like a double top. We did continue to get higher lows and higher highs in this trend. So yes, on this last kind of thrust up into the 34, 35 area, we did have, it wasn't an increase in volume. It was slightly lower than this first thrust up here. But, it didn't fall off crazily. And really, back looking at this technically, it's like, oh, okay, there's probably one more thrust in here, at least kind of back to the midline. And if we can't really move above this area, then that's probably the signal that, okay, markdown's coming real soon. But that's not what we did, right? We just started to sell off very sharply, very abruptly. No particular news, right? No major change in the fundamentals of the company when this took place. And what's curious, and I pointed this out a few weeks ago when this happened, right? This differed from what we saw prior and leading up to the Nikkei crash in August, because what happened then was authentic markdown and distribution, or I should say distribution and then markdown. That was authentic because we saw sell volume on the way down basically meet the buy volume that took us up to, I think it was 29.91 in August. The volume equalized. and then it flattened out and became very low when we started to consolidate and then move sideways. But we did move down a little bit. Actually, after the really deep lows of the Nikkei crash, we never went down to those lows again from early August all the way to now. We haven't ever re-achieved those lows. But on the way down there, on the way down to 1750 pre-market and 1850 open on August 5th, we saw volume equalize the volume that took us up from the 22 area in late June up to 29.91 just before July OPEX. So that was right. A lot of people were crying shorting and how terrible, and there probably was some shorting, right? I don't mean to tell those people that they're wrong, but that looked a lot more. That seemed to me to be an authentic sell-off. That was an authentic profit-taking markdown distribution according to what we would typically expect from organic market activity as framed for us by Wyckoff theory. That's not what happened here, right? Volume actually immediately fell off. Okay, it's not to say that this big red candle we have here, right, wasn't a sizable volume day. I think the days in here are maybe around 8 or 9 million. This was an 11 million day, but here we were in the 12, 13, something like this was like 18 million. Like these were very high, and just instantly when we got this movement, volume fell off. Right, we started trading in the 6, 7 million volume, but green days, right, up days were a higher volume typically than red days. And we moved into something that looked like, and I talked about this last week, right, over for about 2 weeks, a genuine consolidatory period. And what we saw here in terms of volume was, okay, this is equalizing. We're getting to low IV. This is basically looking like we looked in October. We're getting to 52-week lows in volume, 52-week lows in IV, very close. We're seeing this type of consolidation now for 2 weeks. We're seeing also, what was suggestive of, okay, this is looking, and I think Richard Newton even mentioned this, right? Are we now moving into another accumulation phase for the stock, especially because our up moves started to have noticeably more volume than our downward moves? That's suggestive of, oh, okay, we're kind of pivoting out of this, right? This looks like maybe we're getting set up for an up move, another sort of markup phase coming down the horn, right? Coming down the line. And then all of a sudden we got, this movement on Monday, which materialized in the span of about 3 minutes on Sunday night at 8 p.m. And then, okay, we recovered. We didn't quite get back up to our previous channel. We went immediately back into low volume, like 3 million a day, right? And then yesterday we got this same type of movement, a slight volume uptick late in the day, and some redness, right, with suspicion of shorting here. So, what this looks like, right, respective this bearish regression channel, is not emergent from what looks to be traders using these technical markers to navigate buying and selling and trading, so much as it appears to me to be institutions shorting at specific key moments to make it look to someone perhaps who is not, staring at this only this several hours a day, every day, right? Not naming any names, that this is something authentic, right? This is an authentic markdown phase, and it's got a ways left to go. Of course, if you don't find that detail, or if you don't pick out that detail in terms of how our volume looks, or sort of dive into what's happening with our borrowed shares, you wouldn't necessarily notice that. So, okay, right? So, what does that mean for the stock? What does that mean for what traders are doing, right? Like, why aren't traders necessarily coming in and transacting at these prices then? And I think part of it is, right, none of this is is easily discernible, right? You can't necessarily read this according to technical analysis. You can't necessarily use Wyckoff theory to be able to. You can't use volume. You can't use volume data to be able to figure out how this is going to change. Our options chain just kind of keeps kind of falling through to the floor on these moments, right? So you're not going to take too much risk in an options trade. You don't necessarily want to go ahead and move into long puts. One, because you're really not in your favor. A long put is the least favorable structure to a trader as far as any contract that you could trade on GameStop in the options market. So you really want to have super favorable conditions for that. And if you can't go ahead and look at some of these technical levels to say, oh, okay, are we consolidating here? Or, when we move down, is volume really spiking? So, and when we move up, it's really not doing anything. So, okay, there's less risk for me to enter into a put. You can't really use these to make that type of decision. So you're kind of shooting in the dark with that. As far as calls, then, the IV is very favorable, but selecting a strike in terms of, part of the reason why the October calls worked out so well for a lot of people was not only was there low IV, but the floor, right, our sort of downward range was very obvious. We had really stayed a set distance above the 200-day moving average and not tested that level, but stayed within a certain range of it. And we kept logging higher lows throughout this period over the course of several months. Now, in terms of our technicals now, after really diverging from that level, we have more or less returned to the same sort of distanced position. Where we are now in these kind of upper 24 area is very close. It's basically mirroring the distance we had from, let's see, this bottom after quarter 3 earnings in September. This would be September 19th. The distance between our low and our open on that day, I should say, and the 200-day moving average is about what we're looking at right now, right? It's about 65 cents, 60 to 65 cents. Right now, the 200-day moving average is at 24.20. Back then, it was 18.75, something like that. And I think we went down to around 19.35 or something like that. So we're basically, in terms of absolute value of price, distance, we're basically there, right? The last time we even touched this deep technical support on our daily chart was way back. This was in the few days, maybe the 4 or 5 trading days prior to Roaring Kitty's return to X back in May. So basically the first, around May 1st, and 5 trading days or so around there. So, we've kind of just been shorted. Actually, see, that's the thing is, if we look at our daily chart, each of these moves have, specifically when we've gotten heavy shorting, heavy shorting are days that look like very clear instances of targeted interventive institutional shorting. Those are the days that blow us through our moving averages and our technical supports. So, for example, way back on January 14th, we blew through the 20-day moving average and the 50-day, then consolidated kind of on it, then fell a little bit below it, and then moved down and found support around the 100-day moving average. Sort of traded down into that last Monday, gap down, in the overnight period, 8 p.m. on Sunday, through that. And then earlier this week, right, wrote about this, talked about this, consolidated on top of the 100. So moved definitively down from kind of testing the 50, down to the 100, recovered back to the top of the 100. And then yesterday, our shorting pushed us through the 100. So it looks to me like these episodes of shorting are being reserved potentially to test, to really force the issue on these technical supports. So, do we that 200, right? So that 200-day moving average, that is a deep support. I am not sure what to expect there. I mean, if I were under normal circumstances, if I were to just kind of say, okay, I have confidence that the technicals will kind of play out, and knowing what we know about the stock and continuing to basically look at the fundamentals here and anticipate what quarter 4 earnings is going to look like, this is where we reverse, right? Maybe we get today something like that. We get a test of that. We dip down maybe a little bit more, 30 cents, 40 cents, but by and large, we come within a hair's breadth, a stone's throw of the 200-day moving average, and then we start moving back to the upside, and then kind of consolidate in the 25s or slightly below 25 into Friday's expiry, something like that. Now, that's what I think, knowing those things, like kind of that's what makes sense to me. But knowing what we know about how these institutions get access to short liquidity through their kind of ETF looting and strategic fails to deliver, could they push it farther down through that? Could they push us down to what I think would be the 50-week moving average, down at around 22? I guess they could, right? The liquidity's there. I don't have access to their portfolios, right? In these conditions, it's like I don't know what their portfolios look like, so I can't say if they're in a good position to take on the risk of entering into those positions and then having to close out, FTDs pretty abruptly down the line. If they want to risk that, don't know, can't say. But that's kind of what we have from a technical angle here. So it's a question, right? What's really going to happen now with this line? Are they so desperate to push the price down to accommodate, say, some kind of a swap position or a swap roll that they would do this so aggressively? That's such a deep support. I have to imagine that some buyers will come in at that point to kind of pick this back up. Not necessarily, right? Obviously, this is always not trade advice, not investment advice, not exhorting you to go invest or trade in GameStop, but in trying to anticipate, right, to try to reconcile the fundamentals of how, right, the market mechanics or trader psychology or investment psychology works, and how the tools we have at our disposal can come into play. Like to what extent can they actually tell us something useful in the face of adversaries, right, who can manipulate the market in these ways with their synthetic liquidity methods? To where really is the limit on that, and can we identify, say, thresholds where that limit is either reached or very close to being reached in order to predict when there'll be a pivot with respect to strategy on the part of those adversarial institutions? That's what I'm trying to figure out here. So that's what I'll be thinking about, especially with our technicals today. I'll be watching that level pretty closely. If we go down to our options, we'll see that that's kind of an implied. We do have that potential set up for us. Kind of a mix of new calls opened yesterday, right? We can just see traders trying to move calls, trying to open new stuff down here, right, to hedge this down move, because there just isn't, right? There just isn't OI below us. There isn't really OI below 24. Even 24 doesn't even have that much. 24 and a half is barely anything. The stock price is moving so far down and independent of the options market through this. This is the other thing that makes me think it's interventive shorting, right? This is not options. This is not the options market, right? A lot of people too have been posting about, how much volume is being routed off exchange, or, we've seen dark pool trades, right? Large dark pool trades, basically, right? Whatever comes in at the ask doesn't make the lit market. Now, a lot of bids also don't make the lit market, but it's looking like it's pretty much only large bid trades, only large bearish share trades actually make it to the lit market. Whereas anything that's a large trade at the ask goes to a dark pool. That's another, right? Order flow rerouting is another subtle way to be able to manipulate the price like this, where you find that authentic buy volume when it appears. If you're an institution, say, who you want to short the stock and you'd like to see the stock go down, you're bearish on the stock, you go, Oh yeah, okay. If you're, for example, if you're GameStop's equities market maker, right? Citadel is still a GameStop's equities market maker. We know their general orientation towards the stock. They can take that trade, right? They can say, "Oh, OTC this will fill this trade." So trade comes in at the ask. They say, "We'll fill it." They say, "Okay, here you go. Here's your shares," whether or not they have them. And then by the end of the day, either what they'll do is they'll go and borrow them and then deliver the borrowed shares and then go, rob GME shares as an authorized participant through creation orders on an ETF. Then they return the borrowed shares, so they're not paying a fee on the borrowed shares. And then they start a fail to deliver cycle with respect to the ETFs that they've borrowed the shares from, right? So that same thing that happens with respect to shorting directly, that same tactic can be used with order flow rerouting, selective order flow rerouting, rehypothecation can be used, strategic fails to deliver can be used in order to facilitate tactical order flow rerouting, depending on how you like to control the price. So, right, we can see options traders just kind of moving down, trying to get positions here, trying to insert themselves into short calls. Like we have kind of a mix at 25, 25.50, 26. 26.50 was shifted toward the bid primarily. 27 primarily shifted toward the ask. So that's what we were looking at there. Really no new puts, profit taking on puts, it looks like. These 30s here, this contraction was largely cutting losses, right? So these were trades at the bid. We did get some volume, a little bit of volume at 24, not very much. We got more, I think, out at February OPEX, some long puts at 24. 25, we did get a mix of long and short calls, basically an even kind of 600 each side for 25. So, little bit of OI pushing down there to give us some structure, but not a ton. Max pain has moved down to 26, right? Just as these contracts are moving closer, moving farther down, right? It moves max pain, which is at 26 now. And yeah, really interestingly, currently, greater than 99.1% of all call options currently open for this Friday are out of the money. That's not something you see very often, right? Especially with so much of this, with the IV levels you're used to seeing on GameStop. Our implied upside move from where we are right now is basically to 26 based on our IV, and our downside move is down to just above 24. So it's about a $2 movement, but a $1.90 move, something like that, is from our IV. So we could kind of go either way there from that projection, but that would kind of work out for 26 if max pain is 26. Get that move up, maybe finish a little bit below that strike. You're hunky dory if you're the market maker. Happy to see that. But maybe, right, you see it go both ways. So you get the IV move down to that 24.20 area today, so that tomorrow you can move it all the way back up to to 26 or something like that. Don't want to speculate too much, but something like that. If you look at our gamma data, right, that move down, there it is. Look at 24. Look at how big of a put position that's turned out. Look at all the put gamma at 24. We have a fair amount of it at 24.50 too. If we want to run down, if somebody comes and drops some volume here, basically our price is right here, where we have a kind of gamma flip line deal going on with GameStop. We'll run pretty quickly down to 24. I don't, based on how market makers are going to hedge this. They've got short puts on their books, so they're going to hedge that by selling shares as the price moves down. So as the price moves down, it's going to build momentum to the downside until we hit this neutral position at 23.50. So I don't think we'll go that low, but basically it'll stop here on the other side of 24. And then you get a little bit of a bounce, kind of a put wall effect there. And then maybe start to move back to the upside. At the same time, right, I mean, if there is volume that comes in, you wouldn't really need that much to then, pop the stock up to 26. A little bit of resistance there from the amount of call gamma we have concentrated. You need a bit more, a couple million more probably. 8 to 10 million volume if that came in. You'd see a test of 27, easy enough. But whether that's going to happen, whether we see the type of consolidation to give traders that confidence. I think it's going to depend really on these institutions. If they want to go ahead and cover their shorts the old-fashioned way by going ahead and buying shares on the market rather than going through dark pools or by looting ETFs, then they can let that volume out on the lit market and capture some calls, buy some, sell some puts, capture some calls, and then make quite a lot of money in the options market by collecting premium on those, bringing in both options liquidity and share liquidity. Like I said, we do in some ways resemble the way that we looked back on 829 and on September 20th. We look kind of similar in some ways, though the context is very different. Really, the only thing kind of coming up around the bend is Q4 earnings, and that's still about 5 weeks away. So it's hard to say, right? I mean, at this point, what this kind of turns into, the game here, is, hey, who's got swaps that needs to push this lower? Who's got this kind of, who's got this sort of position on their books that they need to hedge by this date? When are FTDs coming due? Things like this. These are questions that kind of divorce themselves from when we kind of blow out these structures, when we kind of blow out our technicals, and when we blow out our option structure like this, with this kind of repeated tactical shorting. Those are the questions that come to the fore. So we do have one sort of technical marker, like I said, right? We've got the 200-day moving average below us that I'll certainly be watching today. Yeah, that's what we're looking at right now. I mean, right in the short term, you don't like, right? You're investing in a company, you don't like bearishness, especially you don't like bearishness to kind of pop up out of nowhere and be divorced from what the sort of organic price action, organic supply and demand, and really how the investment community in general for GameStop feels about the prospects of the stock. But with that being said, what comes up, right? What comes down the horn, regardless of how many times this cycle is entered into, eventually these positions have to be covered. Eventually they have to, that authentic market activity has to come through. Authentic supply and demand has to come through. And as long as the fundamentals of the company keep improving, then there's not a whole lot that can be done in the ultimate span of time, right? GameStop becomes a profitable company. Well, price discovery is going to happen. So yeah, so that's it for today. Thank you guys as always for watching and listening. Look forward to seeing you tomorrow, and look forward to seeing you early and yeah, for our live stream after market close. So thanks very much, everyone. We'll catch you then. Take care.